In the commodity markets, there's one outstanding opportunity that is revealing itself at the moment. I'm going to be showing you the reasons for that opportunity and also highlighting what would invalidate the outlook.
In this video, I'm going to outline an opportunity that's potentially setting up in gold. Now, looking at gold, there is a seasonal pattern that we're approaching that could combine with fundamentals heading into the end of the year, end of December, into the 2021. So seasonal patterns, just so you get your head around this concept, are basically technical signals which often will have a fundamental background. They work across various markets for a number of reasons. It could be weather pattern, harvest period, timing of interest payments, etc., tax payments, investor sentiment, and more. So seasonality is based on historical data, but not every year is the same, obviously, so you have to use it with investor discretion. And the seasonal pattern I want to show with you here is a particular pattern that we see in the gold market. Now, what tends to happen is that gold tends to appreciate in value around the end of December into 2021 on physical demand. The physical demand comes from gold's largest purchaser, which is China. And often around the Lunar New Year, there's a tradition in China that you give gold gifts. This is a large boost for physical gold demand. As you can see here, in the last 10 years, gold has appreciated between the middle of December through to the middle of February, and it's appreciated 9 times out of the last 10 years. So if you had bought gold towards the end of December and held it through to mid of February, if you'd done that for the last 10 years, you would have had an annualized return of 45%. The maximum gain was up to 14.43%, and you can see that was in 2015, whereas the maximum loss was 3.12%, and that was in 2012. All the other years gained. So you see, this is a seasonal demand in the precious metal gold for a fundamental reason: physical demand. Now, let's just have a look at the gold market in its current context. There are a number of bullish factors influencing gold. Interest rates are low. The Federal Reserve expected to keep them on low for the next 3 years till 2023. There's virtually unlimited quantitative easing. That's supportive for gold because it weakens the dollar. There's more US fiscal stimulus still to come in the new year. And we've got this Chinese Lunar New Year demand. All these 4 factors create bullish buying sentiment for gold. Now, obviously, there's bearish factors. So some of the bearish factors is the vaccine news. If you notice when the vaccine news was announced, if you just take a look at the gold chart here, 9th of November, Pfizer BioNTech vaccine news announced, we saw large selling off in gold. The reason is investors who were buying gold thought, well, if vaccines come along, then the Federal Reserve is less likely to cut interest rates, so we might have a return to normality. Gold is losing some of its appeal. So that is one of the bearish factors that we have for gold. We also saw an uptick in US 10-year yield. So if you just take a look at the US 10-year yield chart, what we can see is that there was a strong uptick around the same time up towards that 1% level. And when bond yields are moving higher, that's because expectations are growing for US interest rates rising. So that is there are 2 of the bearish factors that we have to allow for when trading gold. However, the medium-term bias is still to the upside. So where potentially could gold be entered? Well, one potential area is on this 200 exponential moving average at market. Another potential area is if price drops down to that 1760, 1750 region. That's a next layer of support. You can see the key support, it was in May and June earlier of this year. So any retracement down to here or current market prices should find gold buyers. So this could potentially be a fantastic time to buy gold. So looking at the charts, we've seen that the $1,800 or $1,760 regions are pretty good areas for seasonal demand. Now, obviously, what might invalidate this outlook is if there isn't so much travel in China for the Lunar New Year. In the Golden Week holiday in October, there was a lot of travel, so it does bode well. But if COVID-19 starts spreading again in China, then we won't see the travel, we won't see so much gold purchases. Alongside the Federal Reserve potentially raising interest rates sooner. They've got their interest rate meeting around the 16th of December, but they are expected to add extra easing. So everything is looking quite good for a potential gold long into year end. But there's some of the factors you have to balance before deciding. If you found this analysis helpful, please do follow me on Twitter. You can connect with me at LinkedIn. You can also contact me directly at giles.coghlan@hycm.com. And you can contact me direct for some great programs I've set up to help traders take their trading to the very next level. And if you would like to find out more information, please do contact me there. Otherwise, I hope you've enjoyed this analysis and you find this seasonal pattern in gold helpful for your trading.